Hi, welcome to the session of Advanced Financial Management. I'm going to now share the PDF and we'll start the session immediately. I know a few students are still joining, but we'll just introduce the basics before we start the session so that everyone else can also join. So to introduce this paper, this is application of the known financial management tools that we have learned in the previous stages: capital market theories, financial instrument products, how to hedge, speculate, the core concepts of the financial management, the role of the financial manager, etc. So this paper would be in two parts. One 50 mark one, which is compulsory for section A, and then there are two questions which is for section B, 25 marks each. So we'll go through the first chapter itself today. And this is an interesting paper because here we are polishing the skill set as the finance experts, the professional which understand and know the capital market, how to use different financial instrument, etc. To introduce myself and why I'm teaching this, and it is one of the paper I'm very enthusiastic about as well. My name is Nidhish Singh. I am Vice President in JP Morgan, India, and heading the transformation business for the bank, which means predicting, understanding the business requirement for the future, developing the system, application platform, and providing solutions to the investment banking clients. So in that capacity and in my previous roles, I have been responsible for varieties of responsibilities and roles, which includes managing the performance of the team, of the verticals. I've also worked as the finance manager earlier. So I have worked with organizations like, in addition to JP Morgan, SS&C Technologies, Infosys, State Street, Citibank. So let's have this discussion interactive, and this will be a very interesting paper, and it will develop some core expertise. So the role of the financial manager, that is the first starting part of this chapter. As the topic, the roles and responsibilities of the financial manager. By now, I'm sure you'd have heard and studied a lot about this. Some of you might be working in big businesses, should have, or maybe would have seen some roles of financial managers. But let's take a step back and see why the role is still critical for the success of any organization. We are aware that the role of the financial manager, CFO, financial controller is so critical that it is seen as the core business leader in any organization. And that is because a finance manager has multiple responsibility. Unlike before, now the decisions are driven by the CFOs, and he or she becomes assistant in decision making to CEO. Keeping in mind that a finance manager role might evolve into CFO, we can understand that why the exam focus on these roles, and then why a finance manager has different component of their responsibilities. So, and at this stage, I would like to remind, since the paper is going to be vast, we should also use a lot of memory techniques. As the paper makes a progress and will interact more, I will give you some tools and techniques how to use memory techniques to retain the information longer. So for example, here I see F, R, E, E, and S. So something like, you can remember the acronym FREEZE. Okay. So this describes the role of the finance manager. Strategic impact, financial impact, no need to talk about, the financial impact that the finance manager can make by providing the key cost data about cost of capital, IRR, NPV, etc., or ROCE or ROI, right? The financial manager is going to provide the data or maybe the ratios. But strategic impact, how a finance manager can make the impact at the strategic front. If you recall Anthony's model, strategic decisions are taken here, and then tactical and operational here. The finance manager has the role and responsibility all the way up to here at a strategic level as well. Because if a product is being launched, or somebody is talking about launching a product in a new geography, new market sector, what will be the cost or the price of the product? What will be break even required for that? How the product can be launched at a lower cost? What are the risk component associated with this launch of the product? What are the financial risks? So all these strategic insight, break even data can be provided by strategic impact perspective by finance manager. Regulatory impact. Now the question comes that finance manager is not the lawyer. Why he or she will talk about regulatory impact? But the way roles have evolved for financial manager is that they are responsible now for filing, compliance, tax return, or even they are part of the discussion for creating an entity. When I talk about private equity funds, right? And for every private equity, there are finance manager, the financial controllers. They are part of creating entity, maybe some pseudo entity or some strategic unit back in Mauritius or somewhere to route the fund for the private equity entity, but they are part of those discussions. Hence, they are also responsible for a regulatory impact on the business because they have been into all these circles for the discussion. Ethical impact and environmental impact. So we'll further go into the details to understand each component. So link between strategy and finance manager's role. Here we go. The overriding purpose of the firm. And what is that? The mission statement is overriding purpose of the firm, guides and directs all decision takings, and a finance manager contribute to that mission. Let's remind or remember some of the mission statement, right? A firm can have a mission statement which specify what it wants to achieve. Maybe to provide, I think Google has something similar to this, to provide the knowledge to world, right? Google might have something like this. The Facebook try to connect every single person and providing a free platform for everyone to connect to each other at global scale. These are the mission statement of the organization. Very specific, very pointed. And that mission statement drives the strategy, and that strategy is controlled by experts like finance manager. They act within the policy and they help implementing the policy framework, because any finance decision which is taken or any financial decisions or policy implementation, they go through the finance department. Hence, they are responsible for policy framework as well. So remember our acronym for finance managers, FREES. Okay. Now, ethical and social responsibility. The question comes to why the finance manager has to become ethical officer, right? In fact, it starts often from finance. I had heard some objection by a US company and they started to boycott the product because they heard that the product was designed in US but was manufactured in downtown in China, and they heard that there are some human right violation at the manufacturing site. Right? At manufacturing site, there was some human right violation, and company had designed and outsourced everything to one of the Chinese company without doing the due diligence, just because they think they can outsource and get things manufactured at the cheaper price. Well, it's okay to manufacture at the lower cost, but on the same time, they are responsible for ethical decisions as well. And they should check when and where they are outsourcing the business. When they're asking someone to manufacture the product at the lower cost, they should also check how it is going to be manufactured that low, or are there any such issues, ethical violations. Someone can argue that, okay, fine, even if there is an ethical violation and it is still manufactured at a low cost, why the company should worry? They should, because ultimately the perception, the image, and the brand all will be impacted if it is not taken into account. Moving on, stakeholder protection. I would like to highlight here the word, quite important, that I have seen some examiners feedback that keywords are missed, and this is one of the keywords which often are missed: stakeholder protection. So, it is not only shareholder, it is not only shareholder, but the other part of the society or the country or the market who have any interest, or they are affected by the decision of the company, they are called stakeholder. If you, me, anyone is impacted by the activity and the affair of the company, they are a stakeholder, like employee, government, common people, supplier, vendor, banker, banks, all are stakeholder of a company. So stakeholders' interest must be protected, and finance manager has a critical role, because they are the ones who are signing off so many different agreement. They decide the cost, price, right? The interest expenses, how much loan to be taken, and all financial decisions often lead to risk, and risk lead to stakeholders' safety. Next, corporate governance. Role of finance manager again comes here, because they are the ones who will be custodian of who takes loan, if the policies are violated, if financial statement provides true and fair view to the shareholders. So corporate governance, FS, true and fair view. So such things also go through the nose of finance manager. Sustainable development. Well, so imagine a company which is manufacturing why any company, Coca-Cola and Pepsi, when they manufacture cold drinks, do they replace water? Right? When a company is manufacturing any leather goods, which emits a lot of harmful chemicals to the river, do they take any step to purify the rivers or protect the animals or the environment? So sustainable development is important, and finance manager is aware of so many different documents, policy. They are part of the meeting, they are part of the discussions. If they are aware of that sustainability is the key factor that should be considered, they can play an important role in sustainability. We know environment, sustainability, governance, these things are becoming critical. Major investments are driven by these values, ESG. Even we have seen so many documents and the webinar conducted by ACCA. Many professional bodies, in fact, they are talking about ESG. finance manager has a critical role. They are part of the various senior level discussions. They also need to factor that if a company leaves a bad footprint, means damage the environment, somewhere they have to have enough cash left to replenish the damage or kind of compensate the environment for the damage. So finance manager should be aware of the cost that is required to kind of compensate for the damage, reinstate the same situation as they got earlier after the manufacturing is done, right? Financial policy, they are the center of the financial discussion and the policy, how say dividend should be distributed, how much loan should be taken, what should be the cost of interest, financial covenants by banks, are they breached? Are they still intact? Such decisions and discussions are held by finance manager and their team together with the senior management. So here are the examples of the finance function and decisions: investment selections, overall cost of finance, so cost of capital and source of capital. Not all sources of finance are the same, right? We know that. So finance manager has to decide which one is the best or lowest cost of the finance or lowest expenses for the financials resource. Because if we go to bank, they will charge X%, whereas the bond will charge, normally will be sold at Y% rate. Or maybe you don't need to take the bond, bank loan or the bond. You can use the retained earning, right? Or raise equity capital. There are various ways to raise capital, but the cost could be different. Finance manager has to decide that. Distribution and retentions. So this is again from the context of dividend. Typically at the end of the year, when you have triple bottom line, you have X million dollars of profit and then has handsome amount of cash flow, finance team has to decide, finance manager, the financial controller, the finance director has to decide how much to distribute to the shareholders and how much to retain. And why this is important? Because eventually these are the decisions which will impact even the shareholder, because shareholders expect some dividend at the end of the year. And on the same time, they want the company to survive and become larger and better. So if you distribute everything and don't retain, then you don't have the cash to further grow, right? There is like a trade-off. So there should be a trade-off like this. Sorry. So distribution and investment, right? And here comes this. So this is, imagine the graph for investment. This is the graph for distribution. One goes down, as the distribution goes down, you have more money to invest and investment goes up. But on the same time, you can't just ignore the distribution to the shareholders. They also need money and they have some expectation. So you need to find out a balance, an equilibrium point. See this point where the both lines intersect. You need to find out as a finance manager how much to distribute, how much to invest, and both should be balancing. It should not be at any extreme. Next, communication with stakeholders, quite critical. If you don't communicate often with the stakeholders, they'll keep wondering, and we have seen this from earlier papers, from the theory of Mendeley, which is called stakeholder mapping, right? So stakeholder mapping has something like, let me just have, hope you see this one. So stakeholder mapping. So you have something like this. Power and interest of shareholders, A, B, C, D, right? Low power, high power, low interest, high interest, right? And in the sections like this, where you have a high power and high interest, you have customers. Here in section C, which is C, low interest, high power, right? Section C. Section C is normally shareholders. Why I'm showing this is because when you have a shareholder in section C, you need to keep them satisfied. And for customer, you need to know what they want and accept that. They're the most powerful and also most interested party. If they leave, even shareholders cannot save you. How about shareholder? They are not highly interested, but they're very, very powerful. So keep them satisfied and happy. They don't want day-to-day information like customers or must high level of information, but still keep them satisfied, because if they leave, market will crash and they can fire even the management and the CEO. And if they are not satisfied, they will move from C to D. They will become highly interested. Then here comes the employee. Also, even though employee, you need to keep them informed, but do you agree? You need to still talk to them, still communicate, right? You can't not communicate with employee. You need to communicate and keep them happy. Communicate with the shareholders. You need to communicate often with your customer. So communication is key. Hence, the role as a finance manager is to continue to communicate with the stakeholders. Back to this page. Financial planning and control need not explain, that is critical for finance manager. Risk management. So risk of leverage, trading, cost of capital. These are the risk management area, cost of capital, that finance manager is responsible for. Foreign exchange gain and losses, various derivative trading. So all these are under the ambit of risk management. Efficient and effective use of resources. We'll talk about this further down the paper. Investment selection and capital resource allocation. So investment selection, this entails what kind of investment a finance manager should make, and capital resource. So capital resource has been now acquired, capital is acquired, you got X million dollar, but how do you allocate this? So budget allocation, investment decisions. Who makes budget allocation? Same finance manager. And how do they do this? They need to bear in mind the ethics, etc. But when it comes to investment appraisal, there are various ratios often used. So NPV, IRR. What is IRR? Internal rate of return. What does it say? Let me give you a very simple and typical example of IRR. Okay, first year, start with this. Second, third, fourth. Okay, first year you invested 50K, but then you started to earn something. Okay, next year 10K, then 30K, and fourth year you earn how much? 40K. The internal rate of return says that, let me guess some number. something like maybe 12%. So internal rate of return says if you invest all this money somewhere and get 12% of return, so you invest again 30,000 at 12%, another 40,000 at 12% only, right? So 12% should be the rate at which, if you invest everything, all three amounts should become 50,000 in terms of present value. So IRR is the rate, internal rate of return, at which all your cash inflow, present value of cash inflow and outflow will be equal. That means you need to have at least 12%, or at the rate of IRR, you need to have the return to make any investment. If your IRR is 12%, like if you're investing 50,000 and you expected to get all this money, basically, then your IRR is 12%. Now, your cost of capital at which the bank has financed you should be low or high than IRR, because IRR is the rate at which the financial decisions are made. So that should be lower. Okay, so the bank has to finance you at the lower rate, otherwise you'll be at loss. Or in other words, your return has to be higher than IRR if you are making an investment, because IRR is the rate at which all the cash inflow will be equal to the original investment. So that's IRR. NPV has to be positive all the time. What is NPV? So all expense, all income for year 1, 2, 3, 4, basically, they will be calculated at present value. Let me just go to a blank sheet. Year 1, 2, 3, 4, 5, 6. You invested, say, 50K negative, and then you started to earn 10K, 20K, 50K, 50K. Cost of capital is 10%. So what is the expected number? Let's make it a little bigger. What is the expected number? If you take the present value at the rate of 10%, this is just a very high level outline. I'm not presenting in the detail of NPV. When we'll have the separate section, maybe the next session for our NPV, we'll talk about more details of this, and it will be much clearer. But this is just to give you a high level idea. So this is also 10%. So if we take the present value of each such number, that will be equal to, say, something like 150K. And you know that you have invested 100,000 at the start. Okay, what is your NPV? In today's date, you have invested 100,000, and all the value of future money at the rate of 10% is plus 150K. What is your NPV? 50K. All such decisions are taken by our finance managers. And there are various such ratios. Time of capital rationing. What are the capital rationing? The limit of the capital. Then there are two types of capital rationing, hard and soft. And finance manager has to really play around with this. In hard capital, there is complete restriction. You can't raise the money from outside. Soft rationing, when the policy restricts it. Okay, so based on the hard rationing, the finance manager has to decide the soft rationing as well. Then comes all these performance ratios. In order to calculate the performance of the unit or the organization, and dividend announcements are also done on the basis of this financial performance. Earning per share, dividend per share, return on capital employed. We'll learn about these ratios in finer details with a good few examples in subsequent classes. More on investment selections. There are some further information in the boxes. Incorporation of corporate policy issues. So the corporate policy should be fair to everyone, including the vendors and suppliers. They are extended part of your organization. So the policy should be fair to even external parties, right? Vendor suppliers are considered external parties. Methods of investment appraisal. So we have talked about IRR and NPV. Then there are some situation of multiple IRR. There are rules how to make the decisions in case of multiple IRR. Some other methods are also used. Payback method, which is simpler than IRR. Okay, accounting rate of returns. NPV is theoretically superior because normally we take the help of NPV and IRR both while making the decisions of any particular project, because IRR, not to forget, is still a ratio. Okay, if you get a return of say 10% versus say 8% between two projects, right? It seems that 10% is superior, but may not be really, because project A, which is giving 10% and B giving you 8% only, but project A is earning ultimately 200K, whereas project B is earning 500K. Which one is better? Definitely project B. And so percentage return based on IRR, it could be A. But if you consider NPV, the method I just discussed about, you'll see this B is better. So there are various methods and some conflicting methods as well. So we will take an overall decision on the basis of NPV, IRR, and many other factors as well. And it's not only the financial percentage only or financial dollar value only, which helps us decide the project. There are many other factors also. Capital rationing, we have talked about already. Other ways the financial manager takes the decisions are cost benefit analysis, CBA, weighted benefit scoring, weighted average benefits if you have multiple projects. Then comes the dilemma between earning and dividend measures. Because eventually the shareholders often look at dividend payment, but on the same time earning is important. A good finance manager will try to keep a balance between the dividend and earning. Just because somebody is paying the dividend regularly and a healthy dividend, it doesn't mean that the company is doing well. And the finance manager has to make the decision how to make a balance between the two, because they are somewhere related. If you distribute all the earning, then you are not able to make investment in the critical projects. And they will start to dry up. If you don't continue to make investment, you are not going to open the new source of revenue. You're not going to increase the market share. You're not advertising. You're not doing enough research and development. You're not doing innovation, new product development. Hence, earning will be impacted, right, in the long term. So dividend and earning both should be factored while looking at the performance of any organization. Now comes some behavioral part of the organization, right, or the behavioral part of decision making. Right. Just to tell you something interesting, human mind is so much emotional. Okay, and that's why the behavioral finance has got so much of the importance recently. Even for the exam paper, this is one of the frequent visiting topic, behavioral finance. If you look at 2020 paper, you are likely to see at least 8 to 10 numbers marks on behavioral finance itself. And why it is so important? Earlier, just to give you some interesting context, some 30 or 20 years ago, even recently, people were thinking that, finance is like physics. It works like people used to think that finance is like a closed system of physics. When the physics talk about the thermodynamics, and there were some algorithm, log-based complex mathematics in the rules, which was applicable in the quantum physics even, or mechanics. They are applicable in finance because financial system is also a closed system and it works like a natural nature. But that is not the case. You know why? Because human behavior, which is quite unpredictable, makes things complicated in the finance. In the system, or in the hot balloon, or in a quantum physics, or within the atom, there is no human behavior. They have a fixed role, fixed behavior. But in fact, so you can predict how the atom will behave. You can predict how the boiling water will behave, right? But you can't predict how a human will behave. Hence, behavior finance became very, very important in last 20 years. Now, most of the in last 15 years at least, most of the awards in economics have gone to scholars of behavioral finance, and the reason is it is getting prominence. So in the exam also you will see behavioral finance related questions. Now the first one is efficient market hypothesis. What does it say? It says the market is very efficient. All the information, be it insider or market related, everything is already reflecting. But that is not the case. Efficient market hypothesis is not really working out in the real world. Not all the informations are properly priced. That's one thing. Next, behavioral finance. So despite the evidence in support of the efficient market theory, the stock market crashed. And that is because the human behavior is predominantly impacting the market. And what are those human behaviors? We'll see in a minute. So that is one thing, is anchoring. Anchoring is something when one person triggers a behavior and others start to follow. Okay, and how it works in the stock market, because somebody thinks to sell the stock, thinking that the price is too high, sell the stock, they have realized the benefit. Even though there is no evidence, there is no research that the stock should be sold, but everyone will try to follow the herd. In a way, something similar to this herd behavior. So one person sells, other will start also selling, thinking that the person has a good decision and rational. The other person might have just sold the stock for any other reasons. They might need some education, a loan for education, or some other personal reasons, but people will start to follow that because it's called anchoring and triggering. So the one person anchors and others start to follow that, even though there has no logical relevance to the decisions. That's a behavioral issue. Gambler's fallacy. Now, in that mindset, and this is one of the most common behavior I have also seen, if the stock market start to go up, Many people will just try to book the profit and exit, thinking that they have realized enough gain and this is time to return. This is what many times investors have, wealthy investors and successful investors like Warren Buffett has criticized this, that you need to remain invested long term and don't just do a knee-jerk reaction in selling the stock. Going in and out do not make anyone wealthy, but that's gambler fallacy. They will, if the value of the share rise for 7 consecutive days, some investors might sell the shares, right? So that's gambler fallacy. Herd behavior, people will just follow the herd. If the market is going up or share price is going up for a share, they will not look at the fundamentals. They will just start to buying. That is herd behavior. Overreaction and availability bias. Well, you might have seen the overreaction recently. There was news of COVID, new strains of virus in UK. So there were high amount of infection. Many countries closed their door and airport for any flight coming from UK. What happened? Stock market crashed almost for a day or two and crossed by a big number without doing much analysis. But what happened suddenly? That 2 days later only, market started to go up again. So this is overreaction, knee-jerk reaction. And then finally, confirmation bias. If you choose a stock, basically, based on your theory and it works, then you think that your theory was right and you start to buy further. Okay, but if you think your theory did not work, then you will still buy, thinking that means it is going to go up further. So this kind of confirmation bias. In either way, you just try to confirm your theory no matter what. So confirmation bias, when we try to, the first impression can be hard to shake because people also tend to selectively filter and pay more attention to information that supports their opinion. Okay. The mind is pre-programmed to find out the information which support your theory. Be careful with such bias in the mind, and everyone suffer from such bias. Okay. Many people have lost millions. Almost every day, somebody is losing money because of confirmation bias. Interesting behavioral issues. Hindsight bias and overconfidence. So hindsight is something called looking back into the history. So when you look back into the history, you start to think that, okay, because COVID continued for 9 months, the stock market went up. People make some theories. And looking back, it appears that, yeah, it makes sense. And on that basis, you form an idea that, okay, whenever now pandemic spreads, after 8-9 months, the stock market will go up. But that could be just a coincidence. It's called hindsight bias, overconfidence. Because looking back, you can just make some theory, but it is not necessarily true. It may look very polished and good theory looking back in the history, but it may not have any logical rationale. Okay. This is also in the statistics called false correlation. So there seems to be some correlation, but it is false. Let me give you another example. Okay. If you go out in the evening for 4 days around 3 p.m. and then you find out that there is a rain every day at 3 p.m. In that case, you just start to think that, okay, there is some link between you going out in the garden and start to rain. But that correlation is false. It is called spurious and false correlation. So distribution and retention policy. This is, as I said earlier, to balance out between the distribution that you make to shareholders and how much money you want to retain for the investment. Because your projects and critical investment, infrastructure, all require certain amount of continuous investment. So there is a trade-off between distribution to shareholders and investment into the projects. Communication with stakeholders, we have discussed about. These are the stakeholders as per the stakeholder mapping. Internal stakeholder, managers and employees. Then there are external stakeholders who are supplier, vendors, and finally connected ones. Connected ones are the suppliers, vendors, bankers, and you have external ones which are government, public, journalists, and people in the neighborhood. Suppliers and customer will need information about payment policies. Shareholder will need about your financial health, gearing levels, risk profile, dividend policy, expected returns, ROCE, EPS. That is the information needed by shareholders. So you need to provide them and keep them satisfied. So these are communication requirement with the stakeholders. With this, we'll call the class for today, and we'll have another session tomorrow. So we'll make the continuation on this. Tomorrow we'll endeavor to complete this chapter, and further to this, we have appraisal of the projects using and calculating, in fact, IRR, NPV, different ratios, which will help us making the financial decisions. Okay. Any question before we close? Sarmad or anyone else? Okay, I think there's no other question. So see you tomorrow, and we'll continue this. Thank you.